In this video, we're going to talk about Polestar, trading under the ticker symbol PSNY, or if you've been trading the stock for a long time, you may remember it under the ticker symbol GGPI as well. That was the ticker symbol of the SPAC company. So Polestar has been one of those interesting EV companies that has given the market a lot of hope, if not some hype as well, in 2021 and 2022, when the market already starts to go sour overall for other EV companies, right? So we've had like Tesla going multifold during that period of time. We've had Hyliion, we've had NIO, we've even had Nikola before Trevor Milton, disappointed many of us, to put it lightly. But then the arrival of Lucid and the sell-off of Lucid, in my opinion, has broken the market. And then GGPI arrived. This has given people some hope that that company is going to be different, that it's going to deliver much more efficiently to the investors. So it's possible that people think that, right? And also, actually, not that they think that. I know that this was a self-fulfilling prophecy, at least for some time. Then, as the company has become like fully public, so it went not IPO'd, but you know what I mean, right? So it's no longer just a SPAC, but it has become a company on its own. Then things were a little bit more delicate. So usually we do expect stock prices to change significantly around those periods of time. Like sometimes it does go significantly up, but other times it can go lower because people might sell the news, and also because now they've suddenly realized that there is no longer the floor price of $10. So the $10 floor price, or sometimes $20 or $25, depending on the SPAC, is a promise from the SPAC company that if the merger doesn't go through, they're going to give you back your money up to a certain point. So for many SPAC companies, it's like $10. I think for the SPAC company of Bill Ackman, it was something like $20 or $25. I think 25. No, sorry, I think it was 20. They tried to go public with Universal Music. It didn't go through, so in the end, I just decided to accept the option of give back so that they can give me back my money up to that amount. So that played as a hard floor for most SPACs, and it has played really well back in a certain period of time. So around 2020, it's almost like if you've bought a SPAC near the $10 level, it's a guaranteed win. It'll either jump, in which case you can sell for a big profit, or you can sell back at like $10.50 or something like this, because it'll always hover around, like, I would say $9.50 to $11, give or take. So it was a very convenient situation. And this has lasted until, I would say, late 2021, where people started to realize that as soon as a SPAC goes fully public with a merger completed, its price could collapse way below like the $10 level. And this seems to be the case for Polestar at the moment. It's almost down like 40% from the day that the merger was completed. So the company on that day went from GGPI to PSNY. So why is that the case? In my opinion, on one hand, the own fundamentals of Polestar are not very positive, are not very encouraging, because they have just published the fact that they have a widening operating loss. There's also a sector-wide skepticism. I've mentioned this previously, like, for example, we can argue that maybe a few years from now, the technology consisting of batteries, using batteries as a power generator, may no longer be like the most cutting edge technology. that maybe people could use like fuel cell technology as an alternative to the combustion engines. So the advantage of, I would say, fuel cell technology is that it's relatively similar to the combustion engine idea, right? You put in something as a reserve type of energy. This energy itself doesn't require some very advanced technology to preserve, which, by the way, in the case of the EV is the battery. But if this technology doesn't require a very expensive piece of equipment to preserve, then it would have a commercial advantage over like the batteries of electric vehicles. This and the automated driving. So the automated driving is monopolized by a few companies, Tesla being one of them. I'm sure that there are other ones that I'm not aware of, but it's not every single EV company that specializes in this, right? So for those that are not really big into automated driving, there could be a bit of a hurdle going forward. And given that Polestar isn't exactly known, at least as far as I know, it's not very well known for its automated driving, I would say that it's also something to consider. And finally, the possibility that the reality will check in as almost some sort of gravitational force. So what do I mean by this? You know how right now EV companies are like valued almost as tech companies? So what if one day they become valued essentially like cars manufacturers, like the Ford, the Toyota, and the Nissan of this world? Well, by then, the formula would be wildly different, right? For some companies like Tesla, you can make a case that, oh, okay, they have plenty of technologies, they research a bunch of things that they actually need and that is actually relevant, and that's going to keep like a competitive edge. You can't really say the same thing for many other EV companies, because for some, and I'm not saying that this is the case for Polestar necessarily, but for many others, the entirety of their cars are like outsourced. So the components may come from like different third-party sellers, which may or may not give you an edge. So this kind of stuff, along with the fact that right now we're just riding along with the waves, saying that, okay, sure, yeah, they're tech companies. Like, how long is this going to last? All these are going to play a role in influencing the long-term price performance of EV companies. Oh, by the way, did I mention that there are supply issues going on? That there might be supply issues and environmental concerns with the rare earth components that might like damage both its bottom lines and the social image or the environmental image of an EV car. The fact that it's green, the fact that it's clean, the fact that it's the new future. Yeah, like if we factor in the excavation of rare earth, things might play out in a different way. So you see how over the next few years, I believe that we should be careful about like speculating and guessing what kind of future is the EV sector going to enjoy. It might be wonderful. It also might be not much, right? It might also be a big crater. So going forward, I think that the stock price of PSNY, Polestar, will go down and remain so for the short and medium term. It does need to improve its own fundamentals, and to be honest, the entire EV market kind of has to like brighten up in order for the entire endeavor to work within a fairly short period of time of like 12 months or shorter. So like, in other words, something absolutely fantastic needs to happen, either about the sector or about the way cash flow like capital circulates, or about how the company is doing in order for Polestar to go to higher levels. Until then, it's going to be a slow grind to lower places or like temporary recoveries that we're gonna witness. Like it's the current situation is not going to change unless external factors or significant, and they really have to be significant, internal fundamentals have to occur for me to see some like game changer. So as far as buying or selling is concerned, I would say that selling now is certainly not recommended. But if you want to buy, I would say that you have to buy with a spare position or a spare capital, and certainly not with a significant chunk of your capital. This company is still in the early phase. We haven't seen a convincing final product rolling out just yet. And it's possible that within a few years, it's going to blossom into something much larger, or to crater, by the way, or to crater. Because what if it needs to dilute its shareholders in order to keep the ship afloat time and time again, right? If this kind of thing happens, then I would say that that would be it for the company. It's going to go to penny stock territories a few years from now, just like it happened with, I think, either Nano Dimension or Senseonics. I think it was Nano Dimensions. So the kind of investors or traders that I would recommend Polestar to are people who, one, believe in the company. They think that Polestar is a serious player and who is like legit about committing itself to rolling out products and new models. They believe in the entire sector as a whole. They think that the EV sector over the next few years is going to get significantly larger. And also, people who are comfortable with very speculative positions. So they're comfortable with the fact that this position might not pan out the way they wished it did. So in that case, if you're comfortable with all these, or if all these assumptions or assertions apply to you, then I would say go for it. Now is a decent entry point to get into Polestar. Be careful not to dump in all your allocation in at once, and the dollar average cost in within the next 12 to 24 months. I would recommend to commit a maximum exposure from 1 to 3% of your portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.